productive assets that can grow through pricing power and don't have to reinvest a lot. Well, guess what industry that is? Tech.
That's right.
It's tech. So I feel very comfortable, even if inflation is structural, because half my portfolio is tech.
Welcome to the Millennial Investing Podcast. I'm your host, Clay Finck, and today we bring back fan favorite, Adam Seessel. Adam, welcome back to the show.
Clay, thanks for having me back.
Well, it really is a privilege having you back on the show. In your recent appearances in the media, which, I always naturally tune into, you've expressed your interest in Amazon and Alphabet, and you hit on these two companies in the book, but I'd imagine most people aren't only invested in a handful of big tech names. So I invited you back on just to dive a little bit deeper into some of the other names that are outside of big tech, maybe even the next big tech 5, 10, 20 years down the road. So before we dive into the individual picks, how about we start out by just talking about your process for finding and selecting companies to filter down the world of stocks, and then you can really dive deeper into looking into the financials and such.
Yeah, sure. Well, first of all, Clay, thanks for having me back. I've done a bunch of podcasts and interviews in conjunction with promoting the book, Where the Money Is. But few have been better in terms of preparation than yours. So that's why I was happy to come back. Some of the others maybe not quite so ready to come back, but for you, absolutely. So it's great to visit with you again. In terms of process, I go into this in the book, and I recommend, that anyone pick it up if they want to learn more about the process. But basically, Clay, at the beginning, when you're a stock picker, it's very hard because I compare it to the image of a river. The investment ideas are like rivers, and you desperately want to be in that river. And I remember, how do I jump in? How do I get started? And then the answer, of course, is just to jump in, and Buffett says, he's said to people who've asked him for his advice about how to get started stock picking, he said, just order all the annual reports and start with the A's and read them until you get to the Z's, and that's his equivalent of just jump in, just start reading about companies and follow your instincts. What do you like as a consumer? That's important. Or even better, maybe if you're in a business, if you're in sales, you'll know better than me or you, Clay, whether Salesforce is the best CRM platform or whether there's, it's ripe for disruption. If you're in, engineering, you'll know whether ANSYS is the best, computer simulation for prototypes or whether, Altair is better. I mean, I'm just giving examples of some that I've done a little bit of research on. Sports betting, which we're going to talk about, which is the best app. You just start digging in. And then, of course, go through my business management price filter. What's the quality of the business? What's the quality of the management? And what's the price the market's asking you to pay? That really is my process. And, now, of course, now that I've been doing it 25 plus years, as I say in the book, problem is it's not how to source ideas, it's how to triage between them, because I have so many coming at me. Because for every Alphabet that I invest in, there's 10 that I've looked at kind of related to Alphabet that I've rejected. And so, which lane to go down next is the question for me. So it's almost like now it's like, how do I stop drowning in the river of ideas? But that's a good problem to have.
Do companies have to be a certain size for you? It sounds like no. So I'm curious.
No,
you don't look.
No, if there's, obviously when you write a book, George Orwell said all books are failures, and I know what he means now that I've completed one and published one, because there's always things you'd go back and change. And if there was one thing I'd go back and change, it's to say to people, look, this is not just about mega caps. I happen to talk about mega caps a lot, like Alphabet and Amazon, but I try to mention in the book that there's this whole nother generation of companies below them that have every bit of economic power that Alphabet and Amazon do, but aren't, mega cap, companies like Adobe in document productivity, and Ansys, which I mentioned in computer simulation, and Intuit, which I talk quite a lot about in the book, for small business software. There's a whole nother raft, dozens of companies below the Microsofts and Apples and Amazons that are really interesting because they have the market dominance of these mega caps, but aren't mega cap yet. And so that's a good opportunity. So, so no, I do not discriminate on market cap. And, you give me a small cap company that dominates its niche, and I'm in. Like, I own Nathan's Hot Dogs, which has a $300 million market cap. And then I own Alphabet and Amazon. But so what's the commonality? They both are very well managed, and they both dominate their market.
Mm-hmm. It's funny you mentioned Adobe, because I actually just released a mini episode talking about them. And, I kind of came to the conclusion that in comparing it to something like Alphabet, the moat is very strong, but it might not be quite as strong as what Alphabet has. But since Adobe is a much smaller company relative to Alphabet, that gives it a lot more potential upside over the long run. It gives me as an individual investor, potentially an advantage, because I'm ready to weather through whatever market swings, come through. Yeah. Adobe has those temporary headwinds, but eventually over the long run, the superior business, as you say, is going to win out.
Yeah, I generally like Adobe very much, and its management is also top notch. And I think its moat is as strong as Alphabet's personally. I mean, in terms of PDF, PDF is a noun and a verb, so that's pretty good. But that's actually the smaller side of the business. The larger side of the business is this creative cloud where, everybody who wants to do graphics and visuals uses Adobe. And it has tremendous network effects, because if you and I are collaborating on a project, and you're on Adobe, then I have to use Adobe. And it's not just me and you, usually it's 20 people collaborating on a project. So you can't be, we all have to standardize on one. Mm-hmm. So it's kind of a winner take all kind of thing. And so I like Adobe very much. I've owned it off and on, but I just have to say it is more expensive than Alphabet and Amazon.
Right. Now, chapter 11 of your book is titled Buy What You Know, but with a Twist. So yeah. I'm curious, given what you know and what your circle of competencies are, what company or what industry are you most bullish on outside of Amazon and Alphabet?
Right. Well, let me just explain what I meant with buy what you know with a twist. Like, Peter Lynch was famous in the 80s and 90s for saying buy what you know. And that's still very good advice. As I said earlier, sales, you'll know Salesforce, or you'll know Adobe if you're in marketing, or, if you're an engineer, you'll know Ansys, or if you're in construction, you'll know Autodesk, and you'll know the competitors and who's going to dominate and who's going to be vulnerable. But now in the tech age, in the digital age, the buy what you know comes with a twist, because a lot of people in my generation, I'm in my 50s, the stocks we know the best are old economy stocks whose future is probably behind them. I'm thinking about banks. Like, we know banks really well. And Wells Fargo used to be a really reliable compounding machine, but I just can't see how that's going to work, If you're a bank in the early 21st century, when you have all these digital competitors coming at you, offering to do things faster, cheaper, and better for their customers, just strikes me that they're kind of roadkill waiting to happen. So you have to buy what you know, but be careful. You have to. There's a twist. So I do think that tech, generally, whether it's large cap or mega cap or large cap or mid cap or small cap, I do think tech is where the money is. That's why I called the book that. That there's this. We're still fairly early on in this digital revolution where the economy is going to be run increasingly on software. The economy is going to be increasingly dominated by zeros and ones. The product that we're producing is non-physical. It's not manufactured, it's engineered. So tech is my number one, sector weighting. My number two sector weighting, since you ask, is aerospace. And I write about this some in the book through this wonderful company called HEICO, HEICO, which is, capitalism at its best, where, 30 or 40 years ago, a guy who came out of the Graham and Dodd School of Investing found this little company that happened to make generic aerospace parts. And he and his two young sons bought it. And 30 years later, it's now a $20 billion market cap. Precisely because they made generic aerospace parts safer. I love aerospace as an industry structurally because, first of all, there's a lot of growth in aerospace. I think 75% of the world's population has yet to set foot on an airplane. So it's really a call on, rising standards of living, because as people in Latin America and Africa and especially Asia get more disposable income, they want to fly. They want to see America. They want to see Europe. They want to see Australia, wherever. Now, the airlines are a terrible way to play that because it's a commodity business, boom and bust. They've gone bankrupt, many times. Buffett says, if you add up all the profits since Orville Wright started the airplane, there'd probably be a negative sign next to it. So they're bad businesses. But the companies that make the parts are very good businesses because it takes a lot of engineering. In some ways, it's very technical, tech-oriented. But on the other hand, once you're spec'd in an airplane with a certain part, whether it's on the fuselage or the engine or the cabin, the airlines, it's very hard for the airlines to swap that part out. So you're sort of spec'd in. There's 2 million parts on an airplane. So it's really hard to kind of like mix and match. So if you're spec'd in on a component part on that airplane, you've got a generation of growth. And that's why I like aerospace. But of course, capitalism being capitalism, what happened was companies that were spec'd in like GE and Honeywell and General Dynamics, they would take advantage of this position and they would raise prices because they knew when these parts wore out, the airlines had no choice but to come back to GE, who had manufactured the original part. They couldn't go, Southwest Airlines, American Airlines couldn't go and say to company XYZ and say, hey, make this part for me. It's like, well, no, wait, it's really hard. And I don't know, and then even if they could get that, the FAA would say, well, hold on a second, is this part safe? So what HEICO did over 30 years is made generic parts safe. And so they sell at a 30, 40% discount to GE and Honeywell and the other folks who have been abusing their monopoly positions, and yet they still earn good returns on capital, HEICO. So look up that stock chart and you'll see how capitalism works. And then there are other aerospace companies I own, actually. Woodward, which makes parts for the engine, as like a generation of growth in the next generation of jets. Airbus, actually, a European company, has really been kicking Boeing's butt. So there's a lot to like in aerospace, and that's my second biggest holding in terms of sector.
I also wanted to ask you about one of the top headlines for 2022, which I'm sure you've been asked about quite a bit, is inflation.
Yeah.
Many stock investors will tell you that the best inflation hedge is to own productive businesses with pricing power and hold those businesses over very long periods of time. However, even Warren Buffett has started heavily allocating to oil companies, as he seems to be very bullish on oil and, probably wants some sort of inflation protection by buying those productive businesses, but in the commodity sector. What are your thoughts on inflation, hedging inflation for the years to come?
Mm-hmm. It's an excellent question. I've given it quite a bit of thought. You're right. Even if I weren't asked about it, as a money manager, professional money manager, I have to think about it. I don't think Buffett, first of all, is buying oil stocks as a hedge against inflation. I don't think he's doing it for that reason. He likes buying businesses that have had long cycles of underinvestment, and then suddenly, because in a commodity business like oil, there's supply and then there's demand, right? And what he's noticed is over the last 5 or 10 years, the supply is going down in large part, not in large part, but driven in part by these ESG folks who say you can't, if you're BlackRock, invest in fossil fuels. And the BlackRocks of the world are telling ExxonMobil, divest from your fossil fuels. So there's a lot less capital going into finding oil and gas. And yet every year we demand more of it. Alternatives are, probably in our best interest, but it's going to take a long time for alternatives to displace oil and gas. So I think Buffett sees, the supply going like this and the demand going like this, and the stocks are cheap. So he sees, an arbitrage, so to speak, of a few years where oil prices will remain high because supply is going to be constrained and demand will remain high. I mean, he did this with silver, for example. He studied silver for 25 years, and he watched as the inventories declined every year. And until they hit sort of the demand point for silver, then he bought. His bet on railroads was, there used to be 80 railroads, now there are 8. And so he loves industries where the supply is contracting and the demand is steady. And so I think that's why he bought oil. I don't think it's an inflation hedge. Now, in terms of inflation itself, Clay, I mean, I tend to be pretty constructive on inflation in the sense that, I was a young kid in the 70s when we had this stagflation that people were talking about, and OPEC and sustainable high oil prices and so forth. And, Paul Volcker had to raise rates up to 20% and so forth. I just don't think we're in that period. People are freaking out because the 10-year yield is 3%. It's like back where it was in 18, something like that. And then you just sort of think commonsensically through, like, why do we have inflation? Is it a structural kind of thing where all of a sudden there's, not enough cotton and not enough steel and not enough food and not enough, everything that feeds inflation? Or is it a short-term thing caused by the fact that during COVID, we all got a ton of stimulus. So we had more supply of money, more demand. And then we had these supply chain disruptions. So demand up, supply down. Oh, inflation. And, and the cure for high prices is high prices. So you can already see signs of inflation rolling off because people are buying less. The Fed is intent on crushing inflation. So they're going to choke off credit so people buy less. So I'm fairly constructive about inflation. But even if it is structural, which I doubt, I went back and looked and read Buffett's writings in the early 80s when inflation was kind of peaking. And he said pretty much just what you said. He said, the best assets to buy are productive assets with pricing power, except you left out one important thing: asset light. So they don't have to reinvest, because, you have to reinvest in a steel plant, and this year is 100 million to build, and next year is 120, and next year is 150. That's a problem because it eats up your capital, inflation. So productive assets that can grow through pricing power and don't have to reinvest a lot. Well, guess what industry that is? Tech.
That's right.
It's tech. So I feel very comfortable, even if inflation is structural, because half my portfolio is tech.
Well, let's transition to talk about some individual tech companies. The first one being Airbnb. I believe there's a lot to like about this company. They're founder-led. They started from nothing in 2008, and in 2022 have a $71 billion market cap, producing $7 billion in annual revenue over the previous 12 months. And, I was looking at their recent quarterly report, and I was just seeing some astounding results. 103 million nights and experiences booked during the quarter. That's up 25% year over year. The gross booking value was 17 billion, up 27% year over year. And during the quarter, they had 2.1 billion in revenues, which was up 58% year over year. And I thought it was funny, in the letter to shareholders, they also put, we're so confident in our long-term growth and profitability that today we're announcing a $2 billion share repurchase program, which I found to be interesting from a kind of a hyper growth type company. I'm curious if you could just touch on Airbnb and maybe talk about maybe some parts where Airbnb doesn't make the cut in your BMP checklist.
Yeah, Airbnb is interesting, Clay. I've been studying it some this summer. I mean, it's a noun and a verb, right? So that's a good place to start in terms of the B, right? It's branded. It is the category in some ways. And, as you remember from the book, I say, in the book, you want, a business with a small share of a large market and a sustainable edge. So you need three things. So they definitely have a small share of the, overnight stay market. I can't remember what it is, but it's, 5% or something like that. And it's a huge market. The founder, Brian Chesky, who you reference, he likes to say, we're dealing in a market the size of oil. It's as big as the oil market, the overnight lodging. So they do have a small share of a large market. So check on those two subcategories of the business analysis. I'm not so sure they have the really most important, which is the edge. Do they have a sustainable edge like Intuit has in small business software? Do they have an edge like Adobe has in document productivity? Not so sure, and I'll tell you why. They have let's see, they have 4 million hosts and 6 million listings. So 1.5 listing per host. So it's really mom and pops. But, the great thing about capitalism, as I say in the book, is if you identify a market and which Airbnb did, it invented the category, you're going to get competitors, like flies to what. And so it has happened. Vrbo is not really a competitor because they're a niche competitor. They do single family homes in vacation spots. But Booking.com, which is a European company, which really made their marbles by stitching together a network of hotels in Europe. European hotels are much more bespoke than in US. US, we have chains. European hotels are, little hotels in different cities. Booking.com became the front-facing portal for all those little mini hotels, kind of like Airbnb, but for hotels. Booking.com has taken a real run at this business, and they have a potential edge in the sense that if they do it right, they can put their hotel inventory next to what they call their alternative accommodations inventory, their homestay inventory. So they now have, let me see if I get the numbers right. Yeah, 2 million hosts, but 6.5 million listings. So Airbnb has more hosts, but Booking.com has more listings, which will tell you that Booking.com is going after more of the corporate side of the business. And by corporate, I don't mean, traveling for work. I mean, see, this is fascinating about capitalism. Airbnb creates a category. Mom and pop want to make a little extra money renting out their place. They do it. It's a huge hit. Governments get upset. They get involved. I think we're largely through that. But what's more important, more serious, is competitors come, and Booking and the industry changes. So like people who own apartment buildings are all of a sudden going, hey, why do I have to rent my apartments out for 30 days or a year lease? Why don't I just put them on Booking.com or Airbnb and rent them out per night? I'll sell it retail instead of wholesale. So that's how the business is becoming more corporate. It's not just mom and pops now that are getting into this business. It's professional, apartment guys that want to put their inventory online, and they're mainly choosing Booking.com, which you can see because 6.5 million listings, 2 million hosts, that's like 3+ per host. So I talked to Airbnb about this, and they're determined to stick with the mom and pop model, which I find interesting. Like they say in their prospectus, 75% of our bookings were through individuals. And that was 3 years ago, their IPO prospectus. And I ask them now, and they're like, yeah, that hasn't significantly changed. I'm like, well, don't you want to take advantage of the corporate growth? They're like, yeah, sure, we'll take it. But we really believe this business is a mom and pop business. So, I mean, I admire their honesty and I admire their, determination. But I'm not so sure this is just a mom and pop business. I mean, how many big businesses do you know that were built on a cottage industry, like renting out your apartment and your second home? It just feels like the business is going to evolve beyond just, mom and pops. So I'm a little nervous about that. And booking.com, I'm doing research on because they could make a run at Airbnb's market.
You talk in the book about, looking at your own experience. So when I look at my own experience, me and my friends, when we go to travel, we stay, call it 5-7 days at a place. We're going to Airbnb. So is booking.com, more focused in the European markets for now and expanding for there?
They're stronger in the European market, and they have not done as good a job as they could by their own admission in the American market. So it could be where, businesses evolve over all sorts of weird, unanticipated ways. It could be that booking.com dominates Europe and Airbnb dominates the US. But capitalism has a funny way of finding you, So, I wouldn't be surprised if you and your friends start getting pinged by booking.com. Like, hey, check out our inventory, and you can see if you want to stay at, you're going to Provo, Utah. See if you want to do a hotel because we can offer you that, or do you want to do a alternative? We can do that. We'll see what happens. But when it's not clear, I just pass. Mm-hmm. Like I'm happy to watch and observe and keep an open mind. I admire Chesky because he's not a techie, the CEO. He's not, do you know what his background is? He went to the Rhode Island School of Design. He's a product designer. So in that sense, he's much more like Steve Jobs. Mm-hmm. And you can feel that when you go to the app because it's super easy to use and the branding he's done with it and so forth. It's really impressive. But remember, this is also the guy who pre-pandemic, he was going to get into magazines and airlines and cruise ships. I mean, he was pretty wacky. Now, he said he's learned through the pandemic to focus on one thing, which is good. But, not too long ago, he was talking about using all that free cash, not for stock repurchase, but, crazy diversifying moves into patently bad businesses like airlines and magazines. So I'm not convinced the B is right, the business. I'm not convinced the M is right. The price is actually fairly cheap. I mean, it's actually, if you believe it has legs, I'm just not convinced it does.
Mm-hmm. Yeah, at a high level, I was seeing, about a multiple price to free cash flow multiple of about 25, a $71 billion market cap and 2.9 billion in free cash flow. And a couple other interesting statistics I found was 24% of Airbnb users rented a place for 28 days or more, which kind of falls in line with that trend to work from home. Maybe some millennials, people my age, are going out and staying in a new state every single month. Yeah. And another interesting stat I saw was the insider ownership is about 33%. Of the stock is owned by insiders, and that's over $20 billion worth of stock, which is incredibly impressive. So, if someone does decide that, they do have the moat and, it checks off for someone else personally on the management, talk more about the price for Airbnb.
Sure.
Our listeners, go ahead.
Look, in some ways it's a good decision. In my opinion, what investors are faced with Airbnb, because it's a binary decision. Either you believe that, as you say, millennials are going to continue to be digital nomads, be loyal to the Airbnb brand, and not have any competition from Booking.com or anybody else, then Airbnb is a big winner. Big time winner. And, I think the revenues this year are going to be $8 billion. So it's not so hard to see them, in the near future having a $10 billion revenue company. And then, software companies, as I describe at length in the book. I mean, one of the reasons that tech is where the money is because the margins are so enormous. Because Airbnb, they don't have to keep up the real estate. They don't have to pay taxes on the real estate. They don't have to cut the grass. They just have a freaking software app that connects, one group to another group, like no cost of goods. They have to spend some money, making sure that the customers are happy, that the hosts are happy, that the guests are happy. That customer service element does cut into margins. But, I think you can probably make a reasonable case that, their net margin on an earnings power basis is 20%. So if you do $10 billion revenue company at a 20% net margin, that's $2 billion of net income. And on a $70 billion market cap, that's 35 times. That's a little high, but if you really believe that this thing has legs, then, it's not going to stop at $10 billion, $15 billion at a 30% net margin, is $4.5 billion of net income. So play with the numbers like that is what I would recommend, And I think if the bull thesis is correct, the stock is cheap. Mm-hmm. That's what I think.
Another company,
I'm just not convinced it's correct.
Mm-hmm. Another company that I wanted to discuss today was in the sports betting industry, DraftKings. Not a name I was originally too familiar with, but from a high level, I see an extremely volatile stock, rapidly growing revenues, and a company that is deeply free cash flow negative. And seeing that they're, unprofitable in a growth company, I wasn't surprised to see Cathie Wood on the list of people who own this company. Does the fact that it's free cash flow negative automatically push it out of your checklist and off of, a stock that's worth looking into, or is there something underneath the surface that needs to be uncovered?
Well, free cash flow being negative does not automatically cross it off. Amazon has been free cash flow, or at least net income negative, for 2/3 of its corporate history, but they did that on purpose. They could make money. They just decided not to make money so they could reinvest and make more money down the road. I don't think DraftKings is in that position, and I'm not a fan of DraftKings, nor am I a particular fan of Cathie Wood, because I'm all about, Clay, sort of the middle way. Like, on this hand, you have the stodgy old value investors who say, tech is too expensive and I don't understand it. And, and that's a very dangerous attitude, because tech is the future. Tech is just going to become more and more a bigger part of our lives and a bigger part of our economy. So to ignore it and stick your head in the sand willfully and not understand it, instead of taking the time to understand it, is, almost cutting off your nose to spite your face. So I don't have a lot of time for those stodgy people. And I'm a former value investor who educated myself about tech, and am continuing to educate myself about tech, because there's always something to learn. On the other hand, you have these crazy, pie in the sky people who say, every tech company is awesome, and is fairly undiscriminating about tech. So, Coinbase, Carvana, all these crappy companies that were sold, into the mania, they deserve to be taken out and beaten. So I'm trying to synthesize, old school financial principles, return on capital, dominating your market, moats, free cash flow, with these new economy principles. Like, the world has changed, the world is asset light. So there are times when foregoing free cash flow now to build out your moat is good, but DraftKings is not one of them. And I know this because I've studied the business quite closely, and I own one of the sports betting companies, but it's UK based, and it's really not very well known, and your listeners might want to look into it. It's called Flutter. You ever heard of it?
Have not.
It's a terrible name. It doesn't translate well in the U.S. A flutter apparently in the U.K. is like a little bet. Like you make a little bet. It's called a flutter. Horrible name. But anyway, these guys have been doing online sports betting for a generation in the UK and Ireland and Australia, where it's been legal for a generation. So they know their way around, how to bet on this. They started with betting parlors, walking into retail betting parlors, and then they transitioned into this a generation ago. So they understand this. So shortly after the Supreme Court allowed states to legalize sports betting, which was in 2018, Flutter, like within 6 weeks, bought Fanduel. So Fanduel, you obviously have heard of.
Yeah.
It's owned by Flutter. So what's interesting is, and you know this, I nerd out about this stuff. Like every business is like a battlefield with a competitive dynamic, right? So we've talked about Airbnb and homestay. We've talked about document productivity with Adobe. Now let's talk about sports betting. So the reason Airbnb, the reason FanDuel and DraftKings have dominant shares of the sports betting market is because they were the dominant fantasy sports playing companies. So before sports betting was legal, these guys both had great DFS, daily fantasy sports betting companies, where people would come and play rotisserie baseball and football and basketball. So they both had millions of customers who they could convert like that with zero acquisition costs into sports betting customers. So that immediately gave them a huge head start over companies like Caesars, MGM, Bally's, all the legacy casino companies. They have to acquire a customer $200 or $300 per pop. And if you want to get 1 million customers, that's a lot of money. That's a lot of sunk cost. But DraftKings and FanDuel could acquire these customers at next to nothing because they were already daily fantasy sports customers. So it's no surprise that FanDuel is number 1 market share and DraftKings is number 2. But here's the question. Why is FanDuel number 1 in market share? And the answer is quite interesting and took me some time to figure it out. It's because Flutter, who's been doing online sports betting for a generation, knows how to do it better than DraftKings. So Flutter bought FanDuel several months after the Supreme Court legalized sports betting, and they immediately started putting in their algorithms into his different sports, right? Over there, it's soccer and cricket and rugby and horse racing and stuff. Here, it's, American football and baseball and hockey, basketball. But the concepts are the same. You want to engage the customer. You want to give them interesting bets. I'm not a big sports bettor, so I was surprised to find that it's not really a commodity. It's not like I'm going to go and spend, bet $5 on the Yankees to beat the Mets. Most of the betting is this exotic parlays, these same game, where you have 10 bets and they're all contingent on one another, Aaron Judge has to hit a home run and, score less than 3 runs. Bettors, for reasons I don't understand, except for, the fact that, betting is addictive, which is kind of the dark side of it. But these are bad bets. Like 10, the probability you win over 10 bets is very low. So they have the highest margins, these bets, the highest win rate for the house, but it's what customers love. So FanDuel has much better betting same game parlays than DraftKings, because DraftKings was started as an American company. They didn't know what they were doing. They were just daily fantasy sports site. They've had to stand up their business from nothing. Like they've had to learn what FanDuel's parent has learned over 25 years. Like huge competitive edge, FanDuel. So it's no surprise that FanDuel this quarter has a 51% market share, and their engagement, their user time spent on their site during the last NFL season was twice that of DraftKings, precisely because FanDuel has better products, more enticing products. So whether it's basketball, football, baseball, people like FanDuel better because they offer more engaging products than DraftKings, which is really kind of learning on the fly how to invent sports betting. So I really like FanDuel. It has multiple competitive advantages, multiple moats, and the stock is cheap. So I don't like DraftKings, but I do like the FanDuel parent Flutter.
That's interesting. Flutter, I'm seeing just on the revenue line, $2 billion in 2019, $4.4 billion in 2020, and $6 billion in 2021.
Right.
It's larger. Seems to be growing much faster than DraftKings. When was it that they purchased FanDuel?
2018, like literally, I think it was 6 weeks after the Supreme Court decision. I mean, these guys know what they're doing. They're old school betting pros from the UK, and so they have grown share at the expense of DraftKings and smaller people. And, they're unlike a lot of these guys. Like, the problem with the sports betting market right now is everyone's chasing customers. It's like the land grab. It's like kind of like Amazon was in the .com bust. Like, everybody's falling over themselves to get into e-commerce. That's the way it is now with the sports betting. But FanDuel and their parent Flutter has been much more patient than, say, Caesars, which I think is spending $1.5 billion, with $1.5 billion with a B, just to acquire customers. So FanDuel is being much more disciplined, letting other people lose money. They're going to turn a profit in their U.S. business in 2023. Don't confuse a growth industry with a profitable industry. That's one of Buffett's many important maxims, and it's really true in tech. Like in the book, I talk about GoPro, which selfie sticks were a growth industry, but everyone could copy GoPro. So the stock chart went like this. But FanDuel, because they have better product and they have better market share, they can take that cash flow from their leading market share and invest it in better product, and the flywheel gets going, and then now they have an edge. So they not only have great top line growth, but they have a way to protect that growth through better product, better customer retention, better customer engagement.
I almost wonder if DraftKings, has solved the equation of sports betting given their revenue growth. I've heard the CEO claim that once they enter a new state, that there's a 2 to 3 year payback period until it becomes profitable, and then they just reinvest it back into growth. So given that it's just simply an app, is it is there a moat, essentially, is my question.
The moat for FanDuel, DraftKings does not have a moat. DraftKings is losing market share. Their product isn't as good. They're having to acquire customers at an expensive rate. I've heard that rhetoric that you mentioned. I think a lot of it is, fugazi. I think a lot of it is questionable. Whereas FanDuel has proven that they can make money in the UK and Ireland and Australia on sports betting. They have leading market positions in every region that they really concentrate on, and their moat is twofold. One, they have better product. There's a reason that fans spend twice as much time on FanDuel during the NFL season than they do on DraftKings. Twice as much, not 20%, 30%, 100% more time. Like, that's not a coincidence. So their content is better, number one. Number two, because they're the biggest and the most experienced, they have the deepest betting pools. They have more people betting. It's like a market, right? They're like a market maker, and they can see who's betting what. So they have the best odds. They actually can lay better odds than their competitors because they see who's betting what. So their odds in general are 5 or 6% better than the markets. So if the market is offering 2 to 1 for a bet, these guys can offer 2.05 to 1. They can offer better odds to me and still make as much money because they have the deepest pool of knowledge. So they're the lowest cost operator as well as the best content. So they have at least 2 competitive advantages. So I really think that FanDuel has a moat.
Let's transition to talk about one more trend that, it's an area or an industry that definitely seems ripe for disruption, and that's the real estate sector. The 3 kind of tech players I see in this sector is Redfin, Zillow, and Open Door. They seem to be the big players, at least in the public markets that I'm aware of, at least, to potentially transform this industry. Just feels like a dinosaur industry, which is why I wanted to get your opinion on this industry as well. But
Yeah.
I guess my first question would be, with all the red tape around real estate, is it even possible to disrupt this industry?
I think it is possible, Clay. I don't think it's a question of red tape. I don't think that's what the problem is, why there hasn't been disruption. I think if you look at financial services, you would say red tape and regulation. It's very hard to get a banking license and comply with all the rules, state and federal guidelines for banking. But real estate, the barriers to entry are quite low. It's why, your mom and all her friends, or your dad and all his friends, can become real estate brokers like that. The barriers to entry are quite low. There's one, and so I have studied this industry because I had the same instinct as you did. It's a huge industry. It's bigger than oil. It's bigger than oil. It's the biggest industry in America. I can't remember the numbers, but if you add up the mortgage and the title and all this, it's huge. So the opportunity is enormous. So I'm not surprised there have been many tech players trying to crash the gates. The other company that I'm aware of that's trying to disrupt it is called Compass, which is very popular in New York and Florida. You wouldn't necessarily hear about it in Nebraska, but it plays in these high-end markets. And they have this shtick with, we're using the traditional brokerage model, but we have the best tech. And, you can look up that stock. It's flat on its butt, like all the other Redfin and Zillow and so forth. So I've thought quite a bit about why these companies haven't been able to disrupt the traditional model, because to savvy financial folks like you and me, like, why in the world would we pay 6%, or if they're feeling generous, 5% to a broker to do something that's not that frickin' hard? Like stock commissions are zero. What about real estate commissions, dude? And I think the answer, and it does pay to think like this in general in investing, is not very complicated. It's because, in insurance, they talk about low frequency events and high severity, and high frequency events and low severity. So stock trading, you do a lot, preferably not that much, but most people do it, at least once a week. Mm-hmm. So it's high frequency, but it's low severity. Like not one stock trade is going to make or break you, right? So you're constantly doing it. So that's ripe for disruption, because it's on my mind what price I'm paying every week, right? Mm-hmm. And it's not a big deal, whether I screw up a trade or not. I'm much more price sensitive. A house is most people's single biggest investment, mm-hmm. and they don't buy them that often, right? They buy them. I think the average American moves every 7 years, mm-hmm. and so and often you're not moving to buy a new house; you're mm-hmm. renting or whatever. But so it's low frequency but high severity. Mm-hmm. You don't do it very much, but mm-hmm. if you get it wrong,
you want it done right.
You've screwed up your biggest investment. And most people aren't sophisticated like you and me and your listeners. Like, they really don't know what the heck's going on out there. Like, they don't know how to get a mortgage and how to deal with the title company and how to negotiate with the seller. And so they need someone to hold their hand through this biggest transaction of their lives. And I think it really is that simple. I really think it's, because otherwise everybody would be flocking to Redfin, which charges what, 1.5%?
Yep, 1.5%.
Why hasn't that caught fire? I think it's because, in places like where you live in Nebraska and Indiana and Colorado and Washington State and Alabama and Kentucky, people are nervous about this transaction, and they know so-and-so who's been a broker for so and so many years, and they talk a good game, and they brag about how much real estate they've sold, and they trust them. So it's one of the few examples that have, where these frictional costs, where according to classic economics theory, 6% should go to 4, 3, 2, just like it has in stock trading. But I think because it's this low frequency, high severity deal, I think that's why it hasn't. I think that's why it's resisted. That's disruption.
Yeah, that is an interesting take. Given all the research you've done in real estate, are there any companies you own maybe outside the ones I've listed?
I don't own any of those. No. I mean, I can't find a way to crack it. I can't find a way to crack it. And Zillow showed their hand by trying to buy real estate. Like they basically said, this is too hard a business. Like we got to do something else. We need an act two. So, we're going to go from being an asset light, app to buying homes and flipping them. Like how stupid was that? But it was also a sign of like desperation, kind of like Facebook, like social media might not have legs. Let's bet on the metaverse. It was Zillow was like that. So it shows you that these businesses are just, I mean, sometimes you just got to throw up your hands and go, I don't know what's going on, but it's not working. I think I know the answer. I just explained it, but who knows?
That reminds me, actually, Berkshire Hathaway is in the real estate business. What sort of role do they play?
I've studied their business. They're total classic old school real estate. So now you drive around and you'll see Berkshire Hathaway, right, is the realtor. And it's a franchise. So you can rent that name and pay Berkshire a royalty. But then they also own some real estate agencies. Like there's one in the Philadelphia area that I'm familiar with, and they're super smart about it, as you can imagine, because the commission is just one piece of the real estate transaction. Like there's a lot more money to be made in, doing the mortgage, doing the title, doing the servicing. There are all these other little pieces where you can get a nibble.
Yep. There's $100 here, $200 there. It all adds up.
Yeah. So some of the wholly owned brokerages that Berkshire owns are deep into that. And I can't remember the numbers because it's been a while since I looked at it, but and they call it attachment rates, right? Like the broker does the house and they get, half of the commission. If there's another broker on the other side, they get 3% commission, which is great. But then to place the mortgage with a bank, to be the agent that placed the mortgage, the average attachment rate used to be, I think, 15%. That 1 out of 7 times the broker would be able to get extra money for placing the mortgage. At some of these Berkshire things, it's like 2 or 3 times that. Title, getting the title insurance, their attachment rates are super high because they're working their way up the chain. So no, he has been very smart about that. And Buffett, his genius is he looks for industries that don't change. That's his genius, and that's why he hasn't been so wild about tech, because tech changes so fast. So real estate, he bet correctly, but by the way, it was a tiny bet. I mean, it's a tiny little part of his empire, so it wasn't a huge bet. But he's bet correctly that people want their hand held on real estate, and then we can go and get these attachments, these other services as part of the real estate transaction. So, I mean, Apple in many ways is just a consumer products company, right? It's just something that you runs your life. And I think I read recently that the studies show that you touch your iPhone 150 times a day. Like,
yep.
That's not going anywhere, so that's in some ways not tech anymore. I would argue that Alphabet is the same way, and I would argue that Amazon is the same way. They're non-tech. Even, Adobe is not that. Intuit is not that. These are consumer products that are sold on, features and benefits. And like Gillette and Coca-Cola of the late 20th century, people are locked in on them. And that's why tech is so interesting.
Well, Adam, I know you're very busy relaxing on the beach, so I don't want.
Yeah, I was going to say.
I don't want.
Not that busy. I'm at the beach. No, it's.
I don't want to take too much of your time here. Before we close it out, I just want to give you the chance to, give a handoff to your company, your book, anything else you'd like to share before we close it out.
Oh, sure. Well, thanks, Clay. It's been great visiting with you. Your questions are always thought-provoking, and every good money manager should have people questioning him constantly because it sharpens our thinking. Look, if people are interested in the intersection of value investing and tech, they should definitely get the book, Where the Money Is, Amazon.com, or if you don't want to give money to Darth Vader, you can go to your independent bookstore and get it. And, feel free to hit me up on LinkedIn. I'm there on LinkedIn if people want to talk. I've had some nice exchanges with folks and good questions. In terms of my money management business, I run separate accounts. I have a very high minimum of $5 million, but if you got that much to invest and you want a good long-term money manager to compound your capital, you can find me on the internet.
Awesome. Well, I have my copy here, and I can vouch that it's a fantastic book. I had the digital version, but I had to get a physical copy so I could take it with me wherever or read it the next time I'm on the beach. So thank you so much again, Adam.
Well, thanks for buying it twice.
Yeah. Anything for you?
You can make house hacking really difficult or really complex, but really in its simplest form, all house hacking is purchasing a property that has extra space that you're not utilizing and then renting out that extra space to reduce your expenses.